Hello, shot callers. Welcome to our educational series on ETFs. What is an ETF? An ETF stands for Exchange Traded Fund. It was first launched in 1993 by State Street Global Advisors. It was called originally the S&P Trust. Today it's called the S&P or SPDR ETF, and it trades under the symbol of SPY on the New York Stock Exchange. It is designed to track the S&P 500 index. It today is the most widely traded ETF in the world. Quite simply, the SPDR ETF allows an investor a way to track the U.S. economy without having to buy all 500 underlying shares. If you watched my What is an Index video, you'll understand why it's very useful to have a vehicle such as this for investors. By 2019, in the U.S., there were over 3,000 ETFs traded on the U.S. exchanges, worth more than $3 trillion. The global value of ETFs is over $6 trillion. So these things have exploded in popularity since 1993. Why invest in an ETF? I'm going to run you through a few top reasons. The first being cost. Usually the first point that comes up with an ETF investor is the competitive price of investing in them. The average ETF has an expense ratio of about 0.44%. So for every $1,000 that you invest, you would pay approximately $44 per year in management fees. The minimum investments are often lower as well, which makes investing on a monthly basis a little bit easier. Using the S&P 500 SPDR from earlier as an example, the expense ratio is 0.09%. So an investor who invests $1,000 into a SPDR ETF would pay $9. Now, you would also pay a transaction like a stock to buy and sell that ETF, so we mustn't forget about that point. According to Morningstar, the cost for an average no-load mutual fund, so this is different to an ETF, so there's no upfront fee, but you have an annual management fee. For a large cap growth fund, the average cost is about 0.9% per year. So it's important that when you compare an ETF to a mutual fund, that you compare like for like. So I looked at a large cap growth fund, and that was the average expense ratio. The second big topic on why to invest in an ETF or incorporate that into your portfolio is democratization. This is a word we hear a lot these days regarding cryptocurrency and blockchain, but it applies to this topic as well. Without an investment tracker vehicle like an ETF, investors would theoretically have to buy all the underlying stocks of the index. And pension funds used to do something similar until ETFs came along as well, but they had a lot more wherewithal to make those transactions. Individual investors have a much broader menu of investments to access and choose from in order to construct a portfolio that fits their needs. Prior to the inception of an ETF, it was quite difficult and expensive for investors to buy alternative investments such as gold bullion, emerging market stock bond portfolios, currencies, and other alternative asset classes. So it's opened up a much broader menu of investment choices for investors. The third reason to consider ETFs for your portfolio is transparency. Traditional mutual funds and hedge funds are not known for being super transparent with what's in their underlying portfolios. By law, they are only required to report on a quarterly basis, and when they report, it's typically with about a 60-day lag. So by the time you get a report stating what was in what were the underlying investments of your mutual fund, they may have already changed. The tendency is to report a few weeks after quarter end. Additionally, mutual fund managers can and do wander from their investment targets, and this is known as style drift. A large cap growth manager might invest in a mid-cap growth company if he or she thinks perhaps that they're going to be a good strategic fit or an acquisition target for a larger company. They might be right or they might be wrong, but either way, it makes it difficult sometimes to manage a proper asset allocation if you don't know how you are properly invested. We'll talk about this concentration issue in another video, but for now, that's just a side takeaway. Most ETF providers, however, display their entire portfolio on a daily basis on their websites, and most of the financial data services will pick this up as well. The one exception is Vanguard, which reports on a monthly basis. So, furthermore, actively managed ETFs So those who are not just tracking an index, but are actually making calls on what stocks they think will outperform, are required by law to disclose their full portfolios every single day, making them the most transparent ETFs out there. They also tend to be called by names of what they're investing in, which makes it a little bit easier for investors. So you might have the iShares Russell 2000, or the iShares US Treasury Bond 20-year, or iShares Gold. BlackRock has an iShares Aging Population Portfolio ETF, which actually I will talk about in another educational series. Number 4 on the list is liquidity. Your ability to get in and out of the fund at any time during market trading hours. It allows all investors, regardless of size, to transact in a transparent manner with regulatory protections. 5 on our list is taxes. Tax efficiency and fairness is another advantage of ETFs typically. Given the tracking feature of an ETF versus their actively managed peer, they have less turnover, which means more tax efficiency, less buying and less selling. ETFs also have the unique ability to do in-kind redemptions, which means they can be handled by delivering a basket of securities rather than cash on a transaction on a sale. This ability allows ETFs to avoid taxable events that arise from selling securities for cash. Not all ETFs are tax efficient though, so just keep that in mind. Bond and commodity ETFs, as an example, have been known to pay large capital gain distributions in the past. So it's just an overall point of typically being more tax efficient. To sum up, ETFs have become an impactful, accessible, cost-efficient, and creative way for all investors to build a portfolio, as well as to be agile in changing markets. These features are all the more important given the global health crisis that we're going through right now. They allow investors to approach in a more dynamic, macroeconomic, and thematic way, rather than on a single stock basis. They allow you to adapt to shifting return and risk environments, and to keep your asset allocations up to date. For instance, a way to diversify, which many investors may not have been able to access, is, for instance, oil futures or emerging market bonds. Up to a certain point, having these alternative investments can actually reduce risk and increase your return. Now, that is not a call to go out and buy oil futures or emerging market bonds. Just a note to say that by diversifying into a wider group of sectors, you can, up to a point, reduce your risk and increase your return. One quick policy point on the ETF front that I thought I would throw out there is that there's a growing interest to make it a requirement for our elected officials not to be allowed to own individual stocks, but in fact to have their investments in mutual funds or something like an ETF. And I just wanted to point out how flexible, diverse, and economic it is to own a basket of ETFs, and that this might not be a bad way to avoid any perceived or actual conflict of interest amongst the elected officials out there. To close, the proliferation of ETFs has also accelerated the shift of advisory-based fees versus transaction-based fees. As someone who's managed money for over 20 years for people, for families, for institutions, I believe in the value of advice, but I think it should be tied to the advice and not necessarily to the transaction. I've been a steady light in a foggy and at times a violent harbor, helping people to stay calm, keep them on track, asking them to revisit their risk and their return goals. And that's been much more valuable, just stopping them from harming their own portfolio as much as coming up with 1 or 2 brilliant stock investments over the course of several decades. I hope you found this informational and useful, and would ask you to share it with your friends, your family, your network, so that they can also benefit from some of this more basic financial education. I'd be happy if you'd subscribe to the channel and keep updated, because one of the next videos that we will be doing is on big mega trends and loon shots, as Safi Bakal would call them, to talk a little bit about what's coming in the future, what's exciting, so we don't get bogged down in some of the scarier stuff that's going on right now, because there's a lot of exciting things coming as well. So take care, be safe. And last but not least, I wanted to take a moment to wish my 96-year-old grandmother a very happy birthday. She is in Bismarck, North Dakota. And a fun fact about North Dakota is that they produce enough soybeans to make 483 billion crayons each year. Also, apparently, crayons are made from soybeans. So just a little bit of fun to close out this educational series. Take care.